Hello everybody and welcome to the DWA Minute for alletf.com. My name is Amy Kemp. I'm an analyst here at Dorsey Wright, and joining me is Siek. She is also an analyst, and today we wanted to follow up a little bit on an article that we had done last week, actually Thursday of last week, where it had been the anniversary of the market bottom, 2-year anniversary, March 9th. March 9th was the exact date of the market bottom, a date that we all still remember today. And we wanted to look at the best and worst performing ETFs in different asset classes over that period of time. And some of the most interesting observations we found were across the international space and the commodity space, which have really been two of the strongest asset classes over the last 2 years. You know, everything really has rallied, but those have been really housed some of the outliers.
Right, and specifically, two of the best performing international ETFs are the Brazil and Indonesia. The iShares Brazil Small Cap ETF, ticker symbol EWZS, has posted a return of 378% for the past 2 years, believe it or not.
Yeah.
Which means that if you had started your portfolio at $100,000,
right,
you will now have $478,000.
Wow.
Yeah, and
not too shabby.
No, not at all. And the market vectors Indonesia index, ticker symbol IDX, also performed very well, up to 92% for that time, that same time frame.
And that's pretty consistent with what we saw in the international space, that really the emerging markets ETF were the stories. You know, I mean, there were some developed markets, obviously, that moved to the upside, most recently Canada, one of those. But Brazil, Indonesia, obviously both emerging market names.
And on the flip side, the worst performing ETFs, surprisingly, are Mid East, and the Mid East ETF and the MENA Frontier ETF, and they both are the worst, which means that you would expect it to have at least a negative return, right? But in fact, no, they have positive return. The MENA portfolio ETF, ticker symbol PMNA, is up 29%, and the Wisdom Tree Middle East Dividend Fund, GULF, was up 33%. And keep in mind that they are the worst performing ETFs.
Yeah, and well, and something interesting to add to that is that when we were looking at these numbers, I said, well, what were those even before
the crisis
in the Middle East with Egypt and Libya, and they've actually lost 10% just in the last month and a half on top of that. So they were even better up until the unrest over there.
Yeah.
Right. So flipping over to the commodity side of things, no surprise here that the outperformers to the upside were cotton and palladium. Palladium had been the best performing precious metal, and cotton just the best performing commodity over that entire time span, up 350%. The ones that were lagging were two natural gas funds. GAZ is an IPAP ETN product, and UNG is the United States Natural Gas Fund. Those were both down about 60 to 65% or so, and livestock was also considered a laggard. The IPAP Dow Jones Livestock ETN was down 3%, or excuse me, I'm sorry, up 3%. So that's another one of those where you'd expect it to be down, but it was actually in positive numbers, just not quite as astronomical as some of those other commodities.
Right.
So speaking of the commodity arena, another thing we wanted to touch on today was uranium and Japan and what's going on over there. Came across this story obviously this morning in Wall Street Journal. Many of the uranium stocks got hit very hard. There's one uranium ETF out there, symbol URA. It's a Global X product, and that is a commodity equity based ETF. So it's going to be companies in mining, concerned in mining and just the uranium industry as a whole. That ETF was down 18.8% as of about an hour ago or so, noon, today on Monday, and its largest weighting, which is the Cameco Corporation, CCJ is a symbol there, that makes up about 20% of the ETF, and it itself was down 16%, so huge sell-off in that area of the market.
Right, and also we have two developed market ETFs that we want to mention today. One is the EFA and one is the PIZ. They both are focused on developed market, and the EFA it focuses heavily on Japan.
Right.
And believe it or not, it has about 21.5% in Japan, which got hit pretty hard today.
Yeah. Yeah.
And as we're filming right now, if you look at Friday's market action and today, it was down about 2.7%.
Mm-hmm.
On the flip side, if you look at the PIZ, which is also focuses on developed market countries, it only has about a 4% exposure to Japan.
Mm-hmm.
So to a lesser degree, so it didn't get hit as hard. And again, if you look at Friday and today, it is down only about 1.5%.
So it still got hit, but not quite as hard.
Not quite as hard.
And it's all because of just the weightings. And you had done a video earlier in the year with Tommy about different weighting methodologies.
Mm-hmm.
So IFA uses
the cap weighted, whereas PIZ is more
the relative
strength
weighting.
Mm-hmm.
So how that can really make a difference in your portfolio as a whole. So I think that's all we have for today. Thank you for joining us. We will see you next week.